Tightening spreads and debt worries tainting the look of the commercial real estate market this year. But our next guest says fundamentals for the market are sound. For more on the bright spots and storm clouds of the commercial real estate space, let's get to Marcus and Millichap CEO Hessam Nadji joining us here as part of our week-long special, Real Estate, the New Reality. Hessam, it's good to see you. And maybe, we talk about CRE a lot on this show. And maybe we'll just start there, Hessam, kind of your 30,000-foot view of the sector. How healthy and resilient does it look?
Good afternoon. Thanks for having me on the program. We really have to separate the property fundamentals and property performance from the capital markets, interest rates, and valuations. On the property fundamental side of the equation, the industry as a whole is running something in the neighborhood of 90 to 95% occupancy rates, except for the office sector, and is not seeing a massive overbuilding problem or rent collection problem or any kind of a reversal in healthy occupancies. What we are seeing is pockets of overbuilding for apartments. We're definitely seeing pockets of overbuilding for warehouse distribution facilities, which has been really driven by a lot of e-commerce growth over the past 10 years. And other than those two, there is really no signs of any kind of a performance concern or occupancy concern. The office sector is a whole different story. And even there, we have newer properties, especially in suburban markets, that are running on average 11, 12% vacancy rates. And then there's urban office, especially older ones, that are running 25 to 30% vacancy rates. And those happen to get a lot of the headlines and a lot of the focus because of hybrid work solutions and people being reluctant to come back into the office full time, which are legitimate problems. Many of our clients are reporting continued headwinds against getting people back in the office. But it's really limited to urban office, especially the older stock of office buildings. On the capital markets, interest rates and valuation side of the equation, we're still seeing a big bid-ask spread between buyers and sellers and reluctance by banks and credit unions to be actively lending in the market. So that is still the most the biggest area of challenge.
And Hessam, I noticed that the group, in terms of sentiment around the stocks, has not been great. That's true of Marcus and Millichap. That's true of real estate investment trusts. It's really true writ large here. And do you think that sentiment basically has to do with what the outlook for interest rates, and that perhaps the stocks can't recover until we get a little bit closer to when we might actually see cuts?
That's a great question, and there's a direct correlation between the groups, the entire sector's valuation movement, and Fed sentiment. We saw a big run-up in the sector's valuations late last year when interest rates were coming in. The 10-year Treasury had peaked around 5% and then pulled all the way back down to 4%, and you saw the stock prices go up accordingly. And then when the Fed basically changed its mind again, given the inflation readings of the last couple of weeks coming in hotter than expected, and now the notion of delaying the easing cycle, you see the stocks are under pressure again. So there's a direct correlation between Fed expectations and interest rates because of the fact that the cost of debt is such a paramount element to evaluating commercial real estate. The vast majority of transactions use debt in some form. Typically 60 to 70% of the value of an acquisition has been financed, whether it's banks, credit unions, insurance companies, and other forms of lenders, the CMBS market and so on, agency lenders for apartments. And therefore, the sensitivity to the cost of debt has a direct correlation on pricing. And it's not a surprise to see that tight kind of band.
Hessam, I'm curious, when you're talking to your clients right now, what are they most interested in? Where do you see the strongest demand?
It's interesting. There's been so much focus on the Fed, and everyone, at least psychologically, still waiting for the Fed to break the cycle of tightening and introduce the cycle of easing. And there's a lot of kind of dependency on that timing and the shift for when people, I think, are going to become much more aggressive in coming into the market. Meanwhile, what's interesting is that 2 years has now passed since the tightening cycle, and that time frame has brought price corrections, has brought some distress, operational distress, not so much, industry-wide big sell-off of major portfolios, but operational distress in many different product types and markets. And therefore, more properties are coming to market at prices that are far more reasonable. And they're very competitive with the replacement cost. One of the most important metrics for commercial real estate investing is replacement cost. And so a lot of our clients are actually seeing that replacement cost is not much higher than the price they can fetch current assets. And therefore, they're moving ahead even before the Fed really confirms its intention to bring down interest rates with the first reduction. So we're seeing more activity. We're seeing more properties come to market through exclusive listings because those sellers that were waiting for a Hail Mary from the Fed are now seeing that that's not going to come. And interest rates are, even when they start to come in, they're very unlikely to go back to where they were, which was near zero for quite a long time. So there is a whole recalibration and adjustment in the marketplace that's happening as we speak. It just hasn't quite finished its process yet.
Hessam, great to see you. Thanks for joining us as always.
Thanks for having me.